Good evening, ladies and gentlemen. This is Barry Norman on behalf of Prime, brought to you by ADS Securities London, one of the leading platform providers for online trading. Tonight's class is the fundamentals of Forex. Now, our webinar is about to begin, and tonight's class is sponsored by ADS. They are a leader and online broker for offering unequal service, support, education, as well as online trading. They are regulated in many regions throughout the world, and anywhere you can access their site, they are regulated and allowed to trade. And if you go visit the site, you'll see everywhere that they're regulated, and they have offices in Hong Kong. They're regulated in Hong Kong. They have offices in Dubai. They're regulated throughout the Eurozone. So basically, if you're attending the webinar tonight, most likely they are regulated in your home country. They also segregate all of their investors' funds, so you don't have to worry about anything happening to your deposits or your funds when you trade with ADS securities. Now, they offer trading in indices, currencies, commodities, shares, metals, treasury bonds. Just about anything you want to trade, you can trade on the platform, from Forex to CFDs. Anything you want to do is available on the ADS platform. Now, tonight we're going to be talking about the foundations of Forex to try to give you a general understanding of what the Forex market is all about and how you can trade Forex successfully. Now, basically, the Forex market is where banks, businesses, governments, investors, and traders like you and me come to exchange and speculate on currencies. The Forex market is also referred to as the FX market, the currency market, the foreign exchange market, the foreign currency market. It's got lots of pseudonyms, but it all is the Forex market, short or abbreviation for the foreign exchange market. Now, the volume has been growing steadily, and the daily turnover around the world is a staggering $7 trillion. That is how much is traded every day in a foreign exchange markets. That is a huge amount. Now that amount covers central banks, hedge funds, money managers, and of course, again, speculators like you and I. The Forex market is open 24 hours a day, 5 days a week, with the most important trading centers located in London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Sydney, Paris, and I said in Sydney. Okay. Now, what is amazing is there is no centralized exchange for the Forex. It should be noted that there is no central marketplace for Forex markets. Instead, trading is said to be conducted over the counter. It's not like stocks where there's a central marketplace with all orders processed like the New York Stock Exchange. Forex is a product quoted by all the major banks, and not all banks have the exact same price. But when there's a differential, it's in what we call pips. It's a thousandth of a point. But each bank quotes different because each central bank sets the currency rates for their home country. And brokers also set the rates, and what brokers use is usually an average between all the rates that are being offered through all the feeds from all the various sources. But again, it's in a thousandth of a point. You will hardly see a hair of a difference. Now the brokers take all of these feeds from the different banks and the quotes we see from all the other brokers and are an approximate average of them. It's the broker who is effectively transacting the trade and taking the other side of it. They make the market. Now, don't misunderstand this. The broker is not trading against you. Okay, this is something that people get confused quite often. Any regulated provider doesn't hold your trades. His profit or loss has nothing to do with your profit and loss. In fact, he has a bigger incentive for you to make money because a broker in the Forex market makes his money on what's called the spread and transaction fees paid to him by where he's placing the trades. Okay. So he makes little tiny bits of money on every trade, whether it's a winning trade or a losing trade. Now, his job is to have the most or the highest volume of trades. So in other words, if you have $10,000 in your account and you lose 9,000 of it, the most you can trade is $1,000. Well, he's lost his profit because he would rather see you trading $10,000. And since he's also making the spread, the less trades that you can place, the less he's making in spreads. So he's not fighting against you, and he's not rigging the markets against you. He would be very happy if you continually to win or continue to make profit, because he is not the loser on the other end. Okay, when you buy a currency pair, your broker is selling it to you, not another trader. So he's not matching you up. There's no one trader matching another trader. But because a broker could never afford this kind of volume and to be on the other side of the trade, because if he had a million people, on one side of a trade and he was on the other, it's not like a bookie, okay? He could lose everything in a blink of an eye. So he is conducting the other side trade, and then he is offsetting it through the market makers. He's not holding it. So keep this in mind. But you're not trading against another trader. Your trade isn't matched with Bill Smith in Australia, who's trading the same amount of euros and US dollars as you are. No, that doesn't happen. He's sending it to a market maker, and there's a market maker for the euro, there's another market maker for the pound, and he's dispersing it. Now, the foreign exchange market is a global, decentralized marketplace that determines the relative values for different currencies. Unlike other markets, there is no centralized depository or exchange where transactions are conducted. Instead, these transactions are conducted by several market participants in several locations. It is rare that any two currencies will be identical to one another in value. And it's often rare that any two currencies will maintain the same relative value for more than a short period of time. In Forex, the exchange rate between two currencies constantly moves. Now, this is true in 99.9% of the cases. If you're trading some exotics, from some small country, but in most exchanges, you can't even trade these odd currencies because they don't even have a market base to put them. And the cost would be prohibitive because the broker doesn't have a direct relationship with somebody who's going to take them. But if you're dealing with a currency from a small country, it probably doesn't, depends on the cross currency, but say you were using something out of Saudi Arabia and something out of Dubai or Kuwait at the same time, it's the middle of the night, there's probably no movement at all. But these currencies on a whole just aren't available to be traded. You can buy them and sell them on the Forex market. Don't misunderstand me. You can go to a bank or an exchange. Yes, you can buy them. But when we're talking about speculators like you and I with online trading, you will very rarely find them. Now, before we can talk about understanding how to trade Forex, you have to understand what an exchange rate is. And an exchange rate is the value of one currency to another currency. Now, when you're trading, it's got nothing to do with the value or the type of currency you have in your account. So if you have an account in pounds and you want to trade the euro US dollar, you're not converting your pounds to either one of those. Your account is sitting over here. Your profit goes in and out by those, but you're trading the euro against the dollar. Okay. And you make profit if it goes in the direction you selected. Okay. And the profit is the difference between what you bought it for and what you sold it for, or what you sold it for and what you bought it for. And then the profit is then converted into pounds and put into your account. So every currency has a base currency and the currency is traded against. And this is how you actually say them. But we have what we call majors. So like the euro US dollar is how it's quoted mostly around the world. But sometimes when you're in the Eurozone, you might trade it, quote it, US dollar against euro. But when you're trading it online, it's the euro US dollar. And the euro would be the base currency. And if you think the euro will fall, you would trade the dollar to go up. If you think the euro will go up, you'd be trading the dollar to go down. So if you think values will fall, you go short, or you sell now. And if you think values will rise, you go long now. And the nice thing in the Forex market is you can buy or sell. And each trade is offset, because you'd be technically, even though you're not doing it, and it's not coming out of your account because you're counting some pounds, if you're buying euros, you're selling US dollars. If you're selling if you're selling euros, then you're buying it US dollars, and you're buying equal amounts, because the opposite is how you close out the trade. But it's very simple, and you should understand the basics. But basically, if the euro US dollar is trading at 117, and you think the euro US dollar is going to go up, you would trade the euro US dollar to go up. You don't have to get involved in the technicalities. If the dollar weakens or the euro gets stronger, it moves to 117. You make the difference between the 116 and the 117. Less your spread. If you think the euro is going to go down to 115, you sell it, and then you technically would buy it back at the lower price to offset your investment. So the currency exchange rate between two currencies, both of which are not the official currency of the country in which the exchange rate is quoted in, okay, the phrase is also sometimes used to refer to currency quotes which do not involve the US dollar. And this is called cross rates, because most currencies that are traded against the US dollar, regardless of what country you're located in, is always quoted against the US dollar, because they're the majors. So you'll very rarely see, you'll see the USD JPY, that's the US dollar against the Japanese yen. Now, when you quote it the opposite way, it's also the reverse price. It's just flipped over. But because it is considered one of the majors, it's always quoted USD JPY. Like the pound is always pound US dollar. Okay. Now, for example, if the exchange rate between the British pound and the Japanese yen were quoted in an American newspaper, this would be considered a cross rate. Okay. The cross rate is when it's not the currency of the country in which it is quoting. But this becomes unimportant, because when you trade online in online Forex trading, the quotes don't change based on where you're located, because so they trade them by what they're understood of. Euro US dollar, USD JPY, pound against the dollar. These are what's called the majors. Okay, and this is the standard of how they're quoted. So the value of a currency expressed in terms of another, for example, if the euro US dollar is 132, that means 1 euro is worth $1.32. Okay, so the base rate is euro. So that would be 1 euro would be equal to the US dollar, or what the euro is trading for is 132. So right now the euro is about 117. So that means 1 euro would get you $1.17. Now, Forex trading, as it relates to retail traders like you and I, is the speculation on the price of one currency against another. For example, if you think the euro is going to go up, going to rise against the US dollar, you can buy the euro US dollar currency pair low, and then hopefully sell it at a higher price to make a profit. Of course, if you buy the euro against the dollar and the US dollar strengthens, then you'll be in a losing position. So it's important to be aware of the risk involved in Forex trading, not just the reward. But the risk and the reward are the exact opposite. Okay. If you trade the euro to go down and it goes up 2 pips, you lose 2 pips. If you trade it to go up and it goes down, you lose 2 pips. But it's not out of sync. If it goes up, you get the profit. If it goes down, you get the loss. Okay. But if you trade it to go down, because you can sell ahead of buying in the Forex market. So you can trade something to go down or shorting it, or trade it to go up and long it. So just imagine you have to, when you enter a trade, you're either going to buy or sell. If you buy now to close out your trade, you have to sell it. and you get the difference between what you bought it for and what you sold it for. If you think it's going to go up, if you think it's going to go up, you'd buy it now at a lower price and sell it at a higher price later. That's an easy concept. If you think it's going to go down, you technically can sell it now even though you don't possess it, and then buy it back at the lower price, because in order to offset them, you have to do a buy and a sell. So it's the starting price to the closing price. And if you get it in the right direction, you make the profit between the movement. And so if the euro goes up 20 pips, you made 20 pips. If the euro went down 10 pips and you thought it was going to go up, you're out of your pocket 10 pips. Okay, 10 pips is the 4-point decimal all the way to the right, and what a currency is quoted in is called pips. And it's a small, small, small fraction of an amount of money. It's tiny. And therefore, when you trade in Forex, you need to trade using what's called leverage or margin. Because if you invested $1,000 or 1,000 euros to buy the US dollar, and so you invested your 1,000 euros and you got $1,170 for it, and the euro had a really good day and it moved all the way up. What would a euro moving all the way in a really good day? It would move from $1.17 to maybe $1.1710. So originally for your $1,000 you got $1,170. Well, you would get back now $1,171. Well, you risked $1,000 to make, but you get back 1,107. Yeah, 1,170 to $1,171 and no cents, and it went up. It had a nice rally that day. So you need leverage and margin to ramp up your trading, because otherwise it's not worth the risk. You say, I did all that work to make $1. Now, when you think about this market, there's $7 trillion going through this market. So the average currency moves less than 1% per day, either up or down. But when you have $7 trillion trading in the marketplace, in some way, shape, or form, there's a lot of profit to be made out there as well as a lot of losses. So who makes up a good portion of it? It's us, retail traders. We come to the retail trader like you and I. The retail trading is growing every day with the advent of Forex trading platforms and their ease of accessing the internet. Retail Forex traders access the markets indirectly, either through a broker or a bank. There are two main types of retail Forex brokers that provide us with the ability to speculate on the currency market. We have brokers and dealers. Okay. Most of us sitting in this class will never ever get near a dealer. We'll deal with a broker, an online platform provider. Brokers work as an agent for the trader by trying to find the best price in the market and executing on behalf of their customer. Okay. Now, today with online trading, most of us are not, we mix up the term broker, because what we're trading with is an online platform provider who is providing us the ability to go into the market and make a trade. Because a broker is someone, if you really want the definition, who is working on your behalf. Now, the platform's not working not on your behalf, but a broker is someone who's guiding you, advising you, and doing work for you. A platform provider is regulated to provide you a platform without giving you any investment advice. They can educate you, but they can't advise you and they can't trade for you. So dealers are also called market makers because they make the markets for the traders and act as a counterparty to their transactions. These dealers or the market makers are the guys who are on the other side of the trade. They're the ones who are saying, I'm going to buy all the euros, and they have huge billion, trillion dollar liquidities, and all the brokers are sending all of their euro business to them because, like I said, the brokers, the platform, don't hold your trades. They're not the other side. The dealer or the counterparty is the other side. Now, There are many advantages to trading the Forex market, but a good part of it is the liquidity as well as the leverage. It will offer you, and because it trades 24 hours a day, 5 days a week, no matter where you are and no matter what time zone you're in, or no matter what time, whether you're working a job and want to do this in the evening, or you work an evening job and want to do it during daytime, you can find a time that can trade. Now, once you learn to read a quote, which is what we talked about earlier, you have to understand how Forex, or what that unit is being quoted to you in. And this is what I tried to explain to you briefly, is a pip. A pip is a unit you count profit and loss in. Most currency pairs, except for the Japanese yen, are quoted to 4 decimal points. That means when we say the euro is trading at 117, it really isn't. That's what I say and you say. It's not what you see on the broker's platform. It's not what you're trading in, because it's trading in at 117.09. That's $1.1709, all the way over to the right. It's a 1/100th of a cent. And this is what we watch when we talk about pips moving up and down. We don't need to talk about 117.0910. We just say the euro went up 10 pips today. Everybody understands it, because the euro doesn't move from 117 to 116 in one day unless something remarkable, weird happened in the markets. It'll usually go from 117.10 to 117.22. So what did the euro do today? It moved up 12 pips. That's 12/100ths of a cent. So therefore, we're going to use leverage. And as mentioned before, all trades are executed using borrowed money. This allows you to take advantage of leverage. Leverage of 50 to 1 allows you to trade with $1,000 in the market by setting aside approximately $20 as security. So in other words, if you have a $1,000 account at 50 to 1 leverage, you can trade $50,000 worth of an asset. If you have 100 to 1 leverage, you can trade, just put 2 more decimal points to it, and you can trade $100,000 of the marketplace. This allows you then to ramp up your trading, because then if the euro moves 10 pips and you had 100,000 euros, which you only tied up with that $1,000 in your account, what did you end up making today? You made $1,000 profit. So on your $1,000 investment, you made 100% profit. But the risk is just the exact opposite, because if the euro went down 10 pips, you'd be out of your pocket, not your $1,000 deposit. You'd be out of your pocket the $1,000 that went down. But if the euro fell 14 pips today, you'd be out of your pocket $1,400. So even though you had a $1,000 margin, that's not a prepayment. It's not a deposit. It's not an insurance policy. It's not the maximum you can lose. All it is a number set by 2 things. It's set by regulation in the country in which you're in, as well as what the general guidelines would say that currency should move within that day. Because a broker, and this is what your broker or your platform does, is he's the one who's providing you the leverage. Because when he goes out in the marketplace and you've traded 100,000 euros, he needs to put a trade out there of a real 100,000 euros. So he needs to have that 100,000 euros in cash, because he's only let you put down $1,000. So he's putting down that other $99,000 to put it through to the market maker. Now remember, on the other hand, leverage can significantly increase your losses. Trading foreign exchange at any level of leverage may not be suitable for all traders. The specific amount you are required to put aside to hold a position is referred to as your margin. It's not a down payment, it's not a deposit, it's just a requirement. Margin can be thought of as a good faith deposit required to maintain open positions. This is not a fee, it's not a transaction cost. It is simply a portion of your account equity that is set aside. It doesn't even come out of your account. It's just, if you had $10,000 in your account and you wanted to use a $1,000 margin for whatever trade you're making, you had that You still have $10,000 in your account, but $9,000 is available for other trades, and $1,000 is sectioned off that you can't use it until that trade is closed. So just like stocks, you can trade currencies based on what you think its value is going to be or where it's headed. But the big difference with Forex is that you can trade up and down just as easily. If you think a currency will increase in value, you can buy it. If you think it will decrease in value, you can sell it. With a market this large, finding a buyer when you're selling or a seller when you're buying is very easy. So it's not like other markets. All the markets are subject to liquidity, but because there's $7 trillion being traded, there's always a position you can get. Maybe you hear the news on China's devaluing its currency and draw more foreign business into this country. You think that trend will continue, so you make a Forex trade by selling the Chinese currency against another currency. Say the US dollar. The more the Chinese currency devalues against the US dollar, the higher your position. The Chinese currency increases in value while you have sold your position, though, then your losses increase. Now, this sounds a wee bit complicated, but it's not so much once you have it down pat. Now, if you have an opinion, you can go trade it, and you can go over to ADS and open a demo platform, and open up our free demo platform and trade your opinion and see how it works. But get used to understanding what the differences are. So all Forex trades involve two currencies. Okay. Remember that. There's the base currency and then sell currency. Selecting what currency you're going to trade against another currency becomes a skill. Okay. Even though you think because Mario Draghi is making a speech today, he's going to send the euro up. But is the euro going to go up against the dollar, or will it be a better trade against the pound? Okay. Now, this is something you have to learn, and you can learn to make these decisions. Or you could just say, I'm only going to trade 3 different currency pairs, and this is, like I only trade 5 currency pairs. I don't trade anything else. This is all that I trade. This is where my background is. This is where my abilities, my skill, my knowledge, and my history is. But you decide how you want to trade Forex. You could specialize in the yen and all of its crosses. You absolutely decide. You can jump from one to another to another. There's all types of strategies that you can use. Okay. So the major pairs, are the euro US dollar, which is referred to as the euro, the USD Japanese yen, which is called the dollar yen. Then we have the pound US dollar, which is called cable or sterling. Cable is because the underground cable ran from London to New York. So people would say in New York, what was the cable? It was the price that came across from the Bank of England. The amazing thing is the Bank of England was the biggest foreign exchange in the world. So people would wait for the cable from the Bank of England for the prices in the market. And it got to be known as cable. Then the Swiss franc, which traded US dollar against Swiss franc, is called the Swissy. The USD CAD is the dollar Canada, or referred to as the loonie. The Australian US dollar is the Aussie dollar. And then the New Zealand US dollar is the Kiwi. And these are what's considered the major currency pairs. Why? Now, you say, why are some of them in there? Okay, the US Canadian dollar, the Australian US dollar, and the New Zealand are called commodity currencies because they trade major commodities around the globe. But they're not, so we have the 4 prime currency pairs. Then we also have the other crosses, which are the euro, pound, which is a major currency pair. And these are what, if you're a beginning trader, these are what you should specialize in. Because number one, they are traded with the highest volume. Number 2, this is where you get the most news and most information about it. And number 3, this is where you can readily learn because you'll see lots of press, lots of headlines, lots of explanation, lots of daily analysis on these. Okay. Now, the other thing you have to understand when you're trading in the Forex market is we've got the base currency, quote currency. Remember, we got that, the euro US dollar. For 1 euro, we would get, in this case, 1.32 US dollars. So we would say the euro is trading at 132. But then we go to what's called the bid-ask price. And this is very important. This is called the spread. So if you look at the chart over here on the right, and don't get confused about the way the numbers are laid out. This is saying the euro is trading at 136.407. Okay, and this is the sell price. The euro is trading at 136.428. So we know most people don't ever say this first three numbers because that's where it just is. So like I kept saying, the euro's at 117, 117. But what's important are the three digits over there, 117.047. Because this is where you would see the difference. So yes, we would say the euro is trading 136.407 or 136.428. Now there's a bid price and an ask price. And the difference between these two is called the spread. The spread is what the broker is basically charging you. Spreads are pretty well standard in the industry, and the more popular the pair, the tighter the spread. But the difference is, remember I told you, in order to initiate a trade, you would buy a pair going up if you think it's going to go up, or you would sell it going down. To close that trade, you would have to do the opposite side. So in each case, you would have to buy one and then sell the other, or sell one now and buy the other. So the spread is the difference. Now you're not paying the spread price because it's just the difference between the buy and the sell. So in other words, at the end of this trade, we could deduct 21 pips. But you see how far over that is to the right? It makes no difference. It's such a small increment to what we're trading. But this is what the broker is technically charging you. Now, if you can't get your head around it, if you remember when you were going on vacation the last time and you went into the foreign exchange office or the currency conversion office as you're walking down or stop at the hotel desk, you know, the hotel, and you've got say you got euros and you need pound or you need Australian dollars and you're in Australia and you walk up to the desk clerk or you go to the clerk at the currency converter and say, I need to get some Australian dollars, I got euros. He's going to say, well, I'll sell you my Australian dollars today at this price for your euros. And whatever price he quotes you, you give him your euros and he gives you that whatever he quoted you because he bought your euros and he sold you Australian dollars. He sold you. Then your vacation ends and you realize you got extra Australian dollars in your pocket. You're going to the airport to fly back home. You need it back in euros. So you go back to that same guy and you say what? Well, originally you said to him, I want to buy Australian dollars because you need to get Australian. You said, now I've got Australian dollars. I want to sell them back to you. So that he says to you, okay, I'll buy your Australian dollars and I'll sell you the euros for this price. And the difference between what he sold you the euros for, what he bought the euros from you from, and what he sold you the euros now is the spread. So imagine you landed in Australia, you had 1,000 euros in your pocket, and you just said, you know what, I would feel more comfortable I have Australian dollars, even though I'm going to use my credit card everywhere. So you say to the guy, here's 1,000 euros, give me the equal balance in Australian dollars. He gives it to you. Okay. Whatever it was, doesn't matter with the calculators, he gives you the proper amount. Now, you spend your whole vacation, you get ready to go home, and you realize, you know what, I got those Australian dollars tucked in my wallet. I never used them. Let me get back my euros. So you go back to the same guy, back to the same window. Now, two things could happen. If the currency markets hadn't moved all weekend, say it was a Sunday, it was a Sunday morning to Sunday afternoon, you would get back 980 euros, even though the Australian dollar and the euro hadn't moved, because that was the difference or his spread. Basically, it could be called his commission, but he's not selling you on commission. He's selling you the spread. Now, it has to be that if the Australian dollar did really good, you know, you landed on Sunday and all week long that Australian dollar plummeted, the euro went straight up because there was some good economics data out of Australia and there were some bad things out of the Eurozone, and that Australian dollar soared up. Well, you go back with your Australian dollar, hand it back to him. He hands you back 1,150 euros. So not only did you cover the spread, which was 20 euros, You got back 150 more euros than you would expect it. You're shocked. You're thrilled to death. You say to the wife, guess what? We made profit while I was here. So we covered part of that hotel bill with, I didn't even know what happened. And this is what happens in the currency market. When you think of it in relatively small terms and you can put it into your own experience, you can understand what these spreads and what this buy and this sell is. Now it's just transferring it over to the big boys market. And the nice thing is many things affect Forex prices. Some of them are easy for you to understand, so they're not that complicated. But like key factors that influence political or economic stability, monetary policy, currency intervention, natural disasters all have an effect on the value of a currency. When you can see them in the headlines or understand them or get them a little bit faster than somebody else, you might be able to predict which currencies will go. But the nice thing about being a newbie in Forex trading is sometimes you're more successful than those old experienced traders because you're not over evaluating everything. You don't panic. You don't see market sell-offs. You're not, some of us experienced people just get too wrapped up in things. But an ignorant newbie holds positions to profit longer even over weekends, and sometimes it turns out very beneficial. So actually there are 4 beginning stages you pass through. You don't know. What don't you know? You don't know yet. Then you know, but you don't know what you don't know. Then 3 is you know that you don't know, and then 4 is you know it and you mastered it, and then you get so complicated like me that you make less trades or you don't hold on to them long enough. But the best thing about trading in the Forex market, and everybody gets excited about the amount of money they can make. And I'll warn every one of you as a newbie trader, forget how much money you can make. If you learn to manage risk, and the hell with how much money you're going to make, because the nice thing in the Forex market is there are many ways to manage risk. If you can keep your risk to the minimum and keep your emotions out, you will eventually make profits. And it's all about money management and risk management. It's not all about technical stuff and complicated stuff and big trades. Nope. It's setting your risk-reward ratios, setting your profit and loss ratios, understanding them, never getting over your head, never chasing something. So the first thing that any trader needs to know and should master before you get involved in all the technical stuff of how to make a trade and where, what's going to go up and what's going to go down, if you can learn to manage your risk and keep it at a 3-to-1 win-loss ratio, and once you understand it, this you can master in no time at all. Most of the bad trades will be wiped out because you can't project enough profit to make the trade. But you can make a lot of money by spending small amounts of money. Unlike other investors like the stock market, they have to invest a lot of money to make a reasonable profit. You can make a good income through investing small amounts of money. It means you don't have to have a big account. You start with a small account, grow it, and have a reasonable account after a while. So thank you very much for joining us tonight. Again, go to ADS Securities, set up a demo platform, try it out. If you like it, open an account with ADS or anywhere else you want. But give Forex a shot. Have a good night now, and thank you for being part of the Investing.com family, and thank you for supporting ADS Securities. Good night now.